All right. Good morning, everybody. So Hong Kong is basically flat on the morning. Gives us the possibility that we could see some movement in the ADRs if they can come back around and get with the program. Otherwise, everything else is in the green, different spots. The Dow up the most at 0.25%. That's the legacy charts, right? Those household names that even new traders recognize, even if they don't know the symbols. We're going to continue this week with getting more jobs data. Today's ADP report. By the time we get through the morning session, we're pretty much going to be done with all the economic activity for the day, which will leave us open for the afternoon to do something else. So you can see some high impact events today, but they're all through the morning session. By the time we get into lunch, we got those auctions. And then tonight, more data out of Japan. It's interesting how they'll build a narrative to fit whatever it is that's happening on the charts. The crude has this range that it's been in for a while, and it was along the bottom of this range, so it really needed to kind of turn and head back up again. Wasn't a perfect bottom, but certainly along those lows. So we need to start working our way back up. And if you zoom out, sure, we've been lower than this before, lower than that $60. But think about the time frame, and like think about where COVID was, and when oil went below zero, they were actually pouring it back into the caves. They didn't have anywhere to store all the extra, and they were pouring it back into the earth, which is just mind boggling. So we went below zero, and that took us down below that 60 level during COVID. We came back out of it. So we've been, we've got a history of going down that low, but otherwise, we don't really see that kind of change. We hover between that 60 and 100 range. That's our zone that we normally stay in. Of course, we had the shenanigans during the financial crisis before and after. But that's really our sweet spot between 60 and 100. And I worked on those rigs for a lot of years, and the price of those barrels directly affects your job when you work out there, whether you have one or not. So we're back into this low. With every expectation, we're going to have to come back up off of this low. And sure, we could get a little bit lower. We might even threaten something in the mid 50s, but we're going to come back up. This is not one of those trades that are easy, right? It's usually like a buy and hold. You get in and you just suffer through. So all this news about, hey, look at that, crude's going up. Tensions rising in the Middle East, the Red Sea, that strait that they're defending, whatever. Keep your eye on it. It won't be an easy run, but got this bottom down here. Anything less than 60, we're wrong, right? If it gets below that, then obviously we're wrong. Need to reconsider. But anything above 60 is a good shot. And we're sitting at 73. So if they can bring it back down a little, maybe let us in at a cheaper price, that'd be nice. 7:30, 8, 8:15, 8:30, 9:45, 10:30, 11, 11:30. You know, watch the clock. It's a mantra. I say it all the time. Watch the clock. Half hours and full hours are the most important ones to watch. But today is a good example of how even the quarter hour is something worth watching. This is only one data point. At 8:15, we've got the ADP. And at 9:45, another quarter hour, we got PMI composite. So we know from these two examples that economic data comes out on the quarter hour just as much as it does on a half hour and on a new hour. It's not as popular, but these are not every single economic event that's going to happen today. These are just the most popular. I guarantee you there's at least 3 times more than this. Take all of these and multiply it by 3. That's how many data events are going to happen today at the minimum. You just don't hear about it. How many of those other events are going to be on the quarter hour today? Rather than trying to scramble and find every single random event and then trying to figure out which one of those might be impactful to today, watch the clock. When we're getting near a quarter hour, look for a little bit of volume to come in. Anticipate if prices along the lows or against the highs that we could flip there, change everything around and begin running, or break out and begin to expand. If you go back and look at the charts and you apply time to these moves, you'll notice that unless it was shock and awe news, nearly every move that you see in the market is connected to a quarter hour, a half hour, or a new hour. Volume's normal today. They're not too worried about the data that we're going to get. We are continuing to see an increase in the volumes after all of the holidays. We're working our way back up. So we're in a normalized number. Really nothing to see here with that one, so we can turn it off, get it out of the way. We've got a lot of the gamma levels. So we're right underneath 0 gamma and the volatility trigger. We're also right underneath the daily pivot point. We opened underneath that daily pivot point, which automatically puts us in a bearish posture. So that's not to say that we can't turn bullish and go to the upside. And it's not to say that you couldn't have traded long positions when it was offered. It is the idea, though, that if we open up underneath that channel right there, the daily pivot point is in the middle of that channel. A little bit of math gives us these 2 outer lines. If we open up underneath that, we're automatically in a bearish posture. Another thing you want to do when you're looking at that level is compare it with the day before and look at where that level was. Well, the day before, that level was all the way up here. We can also see that the day before, the level was much narrower, skinny. And the reason for that is these levels that are around that pivot point are measured based on how far we moved in previous days. So these things are self-adjusting. When we get a big expansion like we had yesterday, we end up with a broader channel today. The pivot point distance also is worth considering between yesterday and today, but between yesterday and the day before. Is this distance greater than this distance? Pivot point analysis through the floor pivots can offer you some insight about what's going on in the market. Person's pivots, John Person, he actually uses an average of the pivot points. All right, so this is a market breadth indicator. When it's going up, the market goes up. When it's below the 10-period moving average, which is this blue line, then we don't want to take new long positions. We've been underneath that 10 now for the second week. We crossed through at the end of last week. We're now working through it this week. So we don't want to start any new positions while we're underneath there. This one is looking at the NASDAQ, but we can open it up and focus it on the NYSE. This is cumulative volume index. If you're looking at it on TradingView, rather than picking your index like the NASDAQ or the NYSE, you can actually just tell it to look at all indexes, which is cool. I can't do that on Thinkorswim yet. But if we do take it to NYSE, we can see that it's even worse. It's near the lower end of the Bollinger Band. Now, we don't have a Bollinger Band breakout yet, but that's kind of the concern. That'd be a pretty violent move, very likely a decent breakdown in the markets. But I am on a weekly, so we're going to clean it up a little bit, put it on a daily. And again, we got that 10 MA cross, but I'm still on the NYSE. We're nearing the midpoint of the Bollinger, kind of negotiating with that midpoint, but we're still holding above the 20. That 20 doesn't seem right. Check these. Yeah. Okay. Check the numbers later, thinking that that number is not matching its color, but the 10 is accurate. We're underneath the 10. We don't want to open new positions for long swings. And when we put it back on the NASDAQ, we are down through the 10, but I'd say it looks a little healthier. It looks a little better, a little cleaner. So this is not telling us to short the market. It's just telling us to be very careful with trying to go long in any new positions to the upside. Now, the ES is underneath the 10-period moving average on a daily time frame, and we're negotiating with that 20-period moving average on the daily. I'm going to take yesterday's price action, put a band around it so that we have at least that halfback level, 47.66. We have a breakdown level, 50%, and we have a breakout level, another 50%, 48.15. So right now, the halfback is the level of concern. We got to be able to negotiate our way back through that. It lines up really well with this yellow line here. So I'm going to keep my eye on that line through the day. It's the upper end of that channel that we were discussing earlier. Everything just lines up when it's in the right spot. Love it. This is an MDP as well. We haven't hit that daily pivot today, so it's a missed daily pivot, MDP. And we're still working on the DOOR, D-O-O-R. This is something of my own little creation that I've modified from some old school open range material. Day one open range focuses on the first day of the month and sets that day's high and that day's low as your open range, and you plot that for the rest of the month. Since it's day one open range, D-O-O-R. I know this works really well with equities. We're going to find out together how well it works with the futures. So we got our door levels marked. Keep track of them. That's another level that we might interact with should we go to the upside. And it lines up, imagine that, right on the halfback. I'll take it. So 47.65 is an area to struggle with. It's going to be a bit of a chore to get through there. Right now, we've got our own Globex high, the lower end of this channel. Then the gamma levels, daily pivot point, the upper end of this channel, the RTH open of yesterday, RTH high of yesterday, ADR half. It's just a lot of trash to the upside to get through. The bottom is a lot more open. If we can cut through this 20-day moving average that we're negotiating with here this morning, we've got a pivot point or a gamma level. That's an optionality level from spot gamma. Get through that, yesterday's low. Then the ADR half. So far this morning, we haven't hit either end of the ADR levels. So we're not exactly in the middle, right? But we're pretty close to being in the middle. We're only up a dime. So it's a coin toss right now of which direction we can go. It's like sitting in the middle of the basketball court. We could move either direction equally. 10-day, 30-minute volume profile. We are testing the edges of this profile. We are as low on the profile as we can go without really pushing it lower. And we've already started to expand and push it lower. This was the low before we came down and set this new low. Now, we're not going to lose this volume until later today. And we passed through it fast enough that we really didn't leave much of a volume footprint behind. But as the day goes on, we're going to wear this volume out. We're going to take those candles out as we print new ones over here, which should deepen this hollow pocket. And very likely, it'll start to remove enough of this volume here that we're going to lose this point of control. Not exactly sure where it's going to go unless it comes up to that 48.20. But it's worth watching it here today, because if we really start to pick up bottoming volume, right, if they come in and start really trying to defend this low, we'll end up bringing that point of control down, because we will build out volume here today significant enough to bring the profile down. So that's something to kind of keep your eye on. It is, yep. It's one of the reasons when we trade a double bottom that I don't want price to bounce right off of the bottom. Because if it bounces off of the bottom, it's very likely going to pull back a good ways. Because what does that form? An inverted cup and handle. So if you're trying to trade long, you really don't want it to bounce there, because it's just going to come up some and then it's going to head back down. If you want a real double bottom that's going to take you back up to these levels, you want to break that low first, go deeper, then come back up. Because then it's a bear trap and you get to squeeze them and pop their heads off. I know that sounds really violent, but it can't be any worse than dead cats bouncing. So on the 5x5, other than the fact that we've got a very narrow range this morning, we don't have anything here. There's no VPOC from yesterday because we've already crossed through that zone multiple times earlier today. I would argue, though, if we had carried it forward from last night, whoever was up trading through the kill zone at 2 a.m. this morning would have appreciated the VPOC, because that's what this price was hitting and was unable to break through. But since we've hit it and we've crossed through it a couple times, it's no longer a VPOC and we don't need to carry it forward. Having said that, the books will tell you that when it comes to a volume profile, carrying forward the point of control, the value area high and the value area low, and putting it into today's price action is appropriate. There's nothing wrong with doing that. I only carry forward the ones that haven't been hit yet, but that doesn't mean that I'm right, or that you shouldn't do it anyways. I've got enough pivots. I don't need this one. When it comes to how to measure price patterns, Google is really cool. You can go to Google and just click images and search for anything, cup and handle, head and shoulders, wedges, and you'll get a barrage of pictures that'll show you exactly how it looks, how it's formed, how it's measured, without even having to read a book about price action and candle patterns. Because, I mean, who's got time to actually read a book, right? And then it's like learning to trade by pictures, which is really cool. Trading for Dummies 101. I love it. So any question you have about how do I spot a pattern, how do I measure a pattern, how do I plot that pattern out, go to Google, click on images, type it out, and the pictures are worth 1,000 words and explains exactly how to do it. We're outside the box. We didn't have a very big box to begin with this week, but we're outside of it. The question is, are we going to be able to pull it back in again? Yeah, Investopedia is not bad, but then you got to read something, right? Now this is AMD, so let's go back to the ES. We're outside the box. We only have 2 days left. So the question at this point is going to be, are we going to come back in or not? Now, I mentioned earlier in the week that we had stayed inside this range for multiple weeks and that we were kind of due to break out of it, right? This whole week we closed inside at Friday's expiration, and this whole week we closed inside at Friday's expiration. So we were kind of due a breakout, and we're still kind of due a close on Friday out of the box. So far, we're out of the box. It's a good start, but 80% of the time, 8 out of 10 times, price is going to come back in again. And that's really something to consider, that at this point, if we don't break this 47.40 and get a legitimate breakdown, a new leg down from here, we're very likely coming back inside this box. Almost like a magnet, the optionality is going to bring us back in again. So we need to really expand to the downside. Now, we can nerd out and start talking about standard deviations and mathematical calculations to derive the next level down. But the easiest way to do it without just, getting all nerdy this early in the morning is measure half of that range and then send it down to the downside. It's not as fun as doing math, but it gets you the next level down. And it's not a perfect standard deviation, but it'll do, right? Close enough. And that low is really close to a round number, 4,700. So it wouldn't surprise if we overshot that, and that would get us closer to the true standard deviation anyways. So that would be my downside target. If we can't hold 4740, then 4700 is the next level I would focus on. Otherwise, I really expect we're going to come back inside the box. Now, we had a pretty steep decline last week. We got a lot closer to that 10-week moving average. We went from being above the 10 by more than 4% to being above the 10 just a little more than 2%. But we're still a long ways from the 10 at 2.25%. We're on the decline. We have no signal yet that we're going to start working our way back up, but it doesn't owe us a reset. It doesn't owe us coming all the way down to zero. I know this is not a nice, clean, smooth wave, but that is a wave. And there's plenty of examples where we never made it back to the 10 and we started working our way to the upside again. So far, this pullback has been textbook profit taking. We've seen some really big moves between November, December, and now even into the first part of the year. After such massive moves of things that have gone way beyond what they should have gone, it makes sense that we're going to get some pullbacks, but that's all that it is at this point. It's just a pullback, it's just profit taking. So we don't want to get all bared up and try shorting the heck out of everything. I don't think the pullback that we're going to get will look anything like last year from, July, August, September, October, through this whole leg down. I don't think it's going to look anything like that. I think those days are done until the next cycle, right? Because it's just a cycle. We'll go from round and round. Unfortunately for newer traders, if you've never traded before COVID was here, then this market is the only market you've ever known. There's another market. There's an entirely different kind of price action out there. And we're getting closer to it. Every week we get a little bit closer. So I think everybody has agreed at this point that the bear market of last year is done. That we're still, trying to transition and heal, and companies need to prove, that their supply chains are good and they've been able to shrug off the inflation and pass along costs and blah, 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 right? All of that. But that we're not going back to last year's lows and not going back to 2022's lows. So this is just a pullback. There's some levels that you can measure to kind of give a line in the sand. Even the half back at 4,500 would be deeper than I would expect, but there's a 786 level. Call it 4,700. We can get there. We can negotiate with it, break below it, wick down, even close below it. But if we don't get a sustained move down below that level, then that's about as deep as the pullback should be. And we'll look to continue upside trades. We are in a topping pattern though, and that's dangerous. It could turn into a reversal. And a reversal could take us back down to 4,500. But at this point, we don't have a reversal. It is worth noting that we have an equal low. Now, we had an equal low. We went just a little bit lower than the previous low. So it's not an equal low. It's a lower low. That's a little bit dangerous. But on this pullback, we ran up and we got a higher high. It wasn't a fantastic higher high, but it was higher. And now we've got just this little itty bitty low. If you go study topping patterns that turn into reversals, so reversals really, this is what we have. And we have to come down and break that low. And then we would have to come up and get a lower high than that high. And then we would have to go down again and break that low. And that would be your trigger, what they call pure price trigger. We're nowhere near any of that, right? All we have at this point is just a minor low lower than the previous low, but we still have this higher high up here. So we would need price to run up and fail to set a new higher high, then fall back down and break that low with a new low. That's a lot of work before we can call this a downside move. We're just topping out. There's your level for the SPX and the distance when we went into the close of how far away we are from those levels. The ones that you really want to focus on a day-to-day basis is the expected move minimum and maximum. There's some statistical values that go with it, but combined, I believe we stay within the range of these two, plus 70% of the time. Individually, each one of those legs has their own statistic, but off of the top of my head, I don't remember the stats. I remember Apple's for some crazy reason, but not the SPX. But these are the levels for the day, and we're 0.75% from the edges of those levels equally, because the SPX hasn't moved yet, unlike the ES, right? The NASDAQ futures, they're already moving around. If we want a little bit of a hint of which one we're a little closer to now, we can go to the SPY because it has moved in the overnight hours. We're closer to the expected move minimum at 465.25 than we are to the expected move maximum. And this is a 1 day rather than, like the weekly expected move that is all week. The 1 day expected move max is 472.34. There's a call wall at 480. There's a put wall at 465. Well, we're at 469. 465 is nearly 1% away. So it's quite a distance off. They do have 0-day gamma wall or, a 0-day call wall, 475, and a 0-day put wall at 470. But we're underneath both of those, which means we're already underneath the put wall. I know that's just the way it goes. But what that also means is if we try to rally, we have to work our way back through our own put levels. All right, so NVIDIA really close to this put support at just 0.25%. But I do like this because it gives you a max and a min, and then gives you that distance. So on the SPX, we were sitting right in the middle of it. We knew that it was an either or, right? We could go either direction. This morning, with the market down already, 1.25. Well, that's from last night. Look at the extended market. With NVIDIA up this morning about 0.1%. We're a little closer to the upper edge than the lower edge. And since we're basically sitting on support, we've got a lot of room before we hit even the 0-day call wall, let alone the full call wall at 500. Oh boy. So Amazon breaking down this morning. It's down 1%. That puts it 2% away from the lower edge and 4% away from the upper edge. It's underneath put support though, so it's not going to get any help out of the optionality. In fact, they'll probably push those puts. But I don't know. I'd want to see how it acts closer to the open. It might gravitate back towards that put level. Otherwise, a move to the downside, we got the full ADR on Amazon at 146. And below that, the expected move minimum, or the lower edge of the expected move for the day, would be 144 in Amazon. This is a collection of the FANG names: Apple, Amazon, the whole group put into a single candle chart. And it has some weights behind it, but you could just look at the NY FANG. It would give you the same thing. The only difference is the NY FANG isn't open in the pre-market, and this chart works in the pre-market. We can see that they're down again this morning. There's a small gap here between where we are in the pre-market and where we closed yesterday, but we're still holding inside of the door candle. And in the bigger scheme of things for the FANGs, it's been a fantastic run. And we are topped out and giving a pretty good pullback, but we got that higher high. And right now we don't have a higher low. This could turn into a complex reversal where we get a higher low and then a lower high and then we dump. We can get that, but we don't have it yet. So we need to get outside of that door candle. And if we do break that to the downside, we got the 50-period moving average. We'd have to negotiate with that. And then this low down here from the 4th. It's basically 104. The number over here on the right, though, doesn't really matter because we can't trade this. This MACD is telling us that the primary trend is bearish. or the primary trend is bullish. The secondary trend is bearish. We've rolled over, but we haven't confirmed a short yet. Until we get below this zero line, we don't have a confirmed short. We've got weakness, we've got a rollover, but we don't have a confirmed short yet. Primary uptrend, secondary downtrend. And what can happen is this can cross back again. We can flip back up. This could just be a deeper pullback before a continuation to the upside. We're right at that 786 pullback. So I mentioned before, we can wick below it. We can even close below it. We just don't want a sustained drive down below it. Now, the textbooks will tell you that a 618 is the way to go. And I'm not against that 618. I just don't use it. Using a 618 probably made a lot of sense when you were using delayed data back in the 80s and 90s, or even when you had to draw your own chart out back in the 60s and 70s. But I think we've moved beyond that at this point. And if I'm looking at a trend and I see a pullback, the pullback is because there's profit taking. Okay, that makes sense. But I want people so interested in and willing to trade this that they jump in and take the place of those that are leaving. That's why you get small pullbacks and a continuation in something that's strong. If it pulls all the way back to the 618, I'm not going to be so confident about, where's all the exuberant, excited traders coming in to take the place of those taking profit. So I don't want it to come back to the 618. If it does that, I would consider this trend done, but also some pure price patterns like that lower high and breaking this low. Right now, just having pulled back and breaking that low isn't enough for pure price. We need to come up and then come down again, or we have to break this level here. I bring up the NY Fangs because yesterday we really didn't do anything in the Fangs, and they're not ones to sit and do nothing, right? Think of the Fang names: Microsoft, Apple, NVIDIA. They're not known for just sitting there doing nothing. So when we get a pause day, it gives us the chance to begin looking for a breakout of that pause day. And you can see as we came into the holidays, these days, they started to get smaller and smaller. The range was just tight. It was winding up a lot of energy, and we had a really nice expansion to the downside. Well, right now we're in a reasonably wide range, but yesterday we did a lot of work and we ended up going nowhere. We want to just build this up with some energy and hopefully it's a move to the upside. At this point, I don't care which direction it goes. I'll trade it long or short, but it needs to go somewhere. The fact that we're gapped down a little bit isn't really much of a concern yet. So looking at what's up this morning, what's nat gas, Bitcoin, pot stocks, uranium, energy. Uranium is looking, nat gas is looking really good this morning. This is a part of that work to turn things around after the just absolute disaster from that breakout that we had, right? We had that failed breakout and then everything just fell apart. The futures on this is a much cleaner chart. All right, so you kind of see that wedge a little clearly on the weekly. This is the wedge that everybody was focused on. We were all looking to trade this big breakout and run it back, to these previous levels. And instead, we had a little bitty breakout and then it just tanked. So right now we're just trying to clean this mess up. We did manage to keep a higher low, barely, but now we've got a lot of work to do to even try to get back into this, get it back into the game. And the halfback is 2.9. So any move to the upside right now, that's going to be the struggle. Now, this is nat gas on the futures. So just want to take it back to something that most of us are probably willing to trade. This has got a lot of work to do, and it's a bottom fishing play. So it's not like a high conviction 625. So in the pre-market, we're up 571. So we're a lot closer to this 6.0 range, trying to get some of these gaps closed. We got a gap to close. Well, the bottom of a gap to close at 575. If we can get into that channel, then we can close the gap at 591. All right. Yesterday was like a big shakeout on Bitcoin. News came out that the ETF that everybody's focused on for the January 10, news came out that that is a wash. It's not going to happen. And a lot of Bitcoin products hit the dirt, started to sell off. Then other news came in and kind of countermanded that and said, oh, well, it's not out the window yet, but we might have to push the date back some. So then we started to see a rally again. I don't think it's going to be an easy play either way. Just if you're not into playing the Bitcoin itself, playing some proxy of it is probably the way to go. Riot, Mara, Coin, Hut, Hive, one of those, right? A way to get in through a proxy event. And pot stocks are up a little bit. There was a lot of hope earlier in the year that there was going to be some legislation that would really benefit in this space, but that faded as the year wore on when they just saw how absolutely dysfunctional the government is right now. They can't pay the bills, let alone do anything else, like legislation on pot stocks. But it kind of comes in waves. So I wouldn't be surprised if we start seeing some news picking up on, pot stock legislation that kind of gives this space a lift. Remember what I said earlier about oil? It's just a narrative that they're going to bring in to match whatever the chart is doing anyways. So we're kind of building a base down here, a bottoming pattern. If we start working our way back up to these old levels, then they'll apply whatever narrative is going to fit, right? Almost self-fulfilling prophecy. Things that are down, bonds are down the most, which is a little concerning, because that means yields are up. And semiconductors are down this morning. Although we can see here, it's trying to turn around. It's just a lot of violence. Let's bring that over to Thinkorswim, look at it a little bigger. Yeah, it's a big breakdown. All right, on the weekly, this is forming like a big Busby. We had a range, we broke out of it. We're pulling back to validate the old range. We're still holding above the 10-week, so we still have a bullish posture, but there's absolutely no way to deny that this is a significant pullback. This is a gap down on a weekly, and that's like the kiss of death. So the week isn't done. That's one point. And individually, we could go in and trade semiconductor names, probably find some that are, up, some are short, little give and take. But at this point, I would focus on a half back. $169.5 to the upside, or a continued move to the downside at 163.25. That would get us through that 10-week. If we look at the door, we can use that for our measurement. This is day one, right? Day one open range. If we were using a regular open range strategy, say like a 5-minute open or something like that, we would be taking this short once it broke through 50%. And we don't have that yet. Even if we just wanted to do, regular work, then we would focus on yesterday's levels. And there's our 1.5%. We might not get more out of semiconductors than that low that we already have, because we're there. If we continue to expand, however, we've got that 163.29, which is a fib level that we already drew from the higher time frame. That would be the next point that I would focus on. So we still got US dollar Japan headed to the upside. 145 should be that resistance level. I was going to say it should be the resistance level that helps knock the dollar back, but the dollar isn't participating in this move. We can see US dollar Japan here in the lower left. We had a little bit of a pullback, and then we ran right back up to high of day. And we're already well beyond yesterday's high. But if we look at the Dixie down here, we're nowhere near the same location. So what that tells us is we want to focus on the 10-year for Japan. Yep, it's up this morning. So you want to keep your eye on this one. Kind of get a feel for what's going on with US dollar Japan. It's not moving with the Dixie, right? So watching the DXY isn't really going to help us out. But we're still looking at 145 as our resistance, right? So our line in the sand. We want to see Bank of Japan really hold underneath that level. And we've expanded considerably today, so hard to see that we're going to get more out of it. We're already beyond the half back level. So that kind of negates the idea that this is just a pullback before continuing to go lower, and that we're more than likely going to build some sort of base in here, or we're just going to transition and run back up. From a trend line, we've already broke over. So for the TRB, we're broke through. If we overshoot, then the halfback is 146.38. The idea is if this stalls, gets tangled up here and fails to break through and continue to the upside, that possibly the idea would be the same with the Dixie. The dollar would fail to like get up into 103, 104, but it's already not rising anyway. So that's helpful. We're just not seeing the follow through in the market. We see S&P and NASDAQ both under VWAP, the NASDAQ quite away from VWAP. 10 years not broke out, but we do have this higher low and higher highs now. We're past the halfway point. I would keep my eye on the 10 years, see if we're going to continue that expansion. 4.0 is the level to stay in focus on. See how we reacted yesterday in the market when we got to the 4.0 and fell here. We got to that level and ran up to VWAP here in the NASDAQ. So it's not like we kept going. You know, it didn't help us like that, but it never pulled back. It just kept on going in a tailspin to the downside. So semiconductors, China ADRs, and bonds are down the most. Those semiconductors are really going to screw us up for any sort of a rally today. They can hold us back. So what we want to see is semis quit falling. They don't necessarily have to run with us, but if they quit falling, that can give the rest of the market room to run to the upside. I'm not seeing that capital rotation that we were focused on. If we look at names that were up the most in the S&P yesterday, the top 10 names that were up in the S&P yesterday, energy, materials, industrial services, distribution, those were the top 10 in the S&P 500. And the ones that were down the most, the lowest 10, were technology, all sorts of different technology. Health technology, electronic technology, more health technology, and then electric again. So that, I guess, is supporting that rotation because it wasn't technology that was up, right? And it wasn't consumer spending and staples that was down. It was the opposite. So we're still seeing that rotation. The question still holds, is it a rotation or just profit taking? We don't have enough information yet. Coke, Colgate, and Merrick are right up against their call resistance or underneath it. I found some of them when I've been using this screen are underneath their call resistance. So all the names on the list, including Walmart, but Walmart's a considerable distance from that level. 159.30, and the call resistance is at 160. So capture a screenshot, if you want it. This is these are short duration names that are right up against resistance. They're call wall. And that can give you a short-term trade for like a call credit spread, or depending on how things move, buying some puts. And from the other side, these are things that are closest to their put support. NVIDIA really stands out. We saw what's happening with Amazon. These numbers aren't using this morning's price action. So kind of keep that in mind when you're looking at it. It makes me say that because I know Amazon fell out of bed. So it's already cut through that level. But capture a screenshot if you're interested in it. This is things that you would consider for a put credit spread, or if you're aggressive and depending on what you see in the chart, just buying a call. It is short duration stuff, right? We're looking at things in relation to their largest options structure. Call wall, put wall, that sort of thing. All right, everybody. Be careful, be safe, have a good day. I'll see y'all tomorrow.